Hello everyone and welcome to lesson 15. Today we are going to talk about MACD, which is one of the most popular technical indicators used in Forex trading. Before we start, make sure you subscribe to the channel and hit the like button. We really appreciate your support. And if you have any questions, put them down in the comments below. We always read your comments. If you are looking for a highly profitable trading system, you should head over to our website, smartforextrading.com. Over 90,000 traders use the Smart Forex Trading system. If you are struggling in your trading, you should start using the Smart Forex Trading system. Remember, once you have a profitable system, trading becomes easy. Make sure you like, subscribe, and turn on bell notifications. It really helps the channel to grow. Before we jump into the lesson, a quick disclaimer. Smart Forex Trading offer educational videos to help and educate Forex traders. Information on this channel is for educational purposes only and should not be considered financial advice. We must advise you Forex trading carries a high level of risk, and you should be aware of the risks before trading in Forex. Hello and welcome to lesson 15 to complete guide to MACD. Let's begin. First of all, we need to know what is it MACD? MACD is an acronym for Moving Average Convergence Divergence. The MACD, or Moving Average Convergence Divergence indicator, is a momentum oscillator used to trade trends. MACD plots the distance between moving averages and helps traders identify trend direction and whether the bullish or bearish momentum in the price is strengthening or weakening. Although MACD is an oscillator, it is not typically used to identify overbought or oversold conditions. The MACD is a trend-following indicator since its purpose is to show the differences between two moving averages. We will be showing you a MACD indicator on TradingView platform. We will open our TradingView platform. Right at the top and click on Indicators. Now type in MACD and you can see many different MACD indicators. For today we will be using MACD_VXI. This is what it looks like on the screen. With a MACD chart, you will usually see three numbers that are used for its settings. The first is the number of periods that are used to calculate the faster moving average. The second is the number of periods that are used in the slower moving average. And the third is the number of bars that are used to calculate the moving average of the difference between the faster and slower moving averages. For example, if you were to see 13, 21, 8 as the MACD parameters, this is how you would interpret it. The 13 represents a moving average of the previous 13 bars. The 21 represents a moving average of the previous 21 bars. The 8 represents a moving average of the difference between the two moving averages above. The difference between the two MAs is plotted as one line, and a second line plots a smoothed version of the first line. These two lines appear on a chart as a technical indicator and oscillate without boundaries. The crossover of the two lines gives trading signals similar to a moving average crossover system. There are two lines of the MACD: 1. The MACD line. 2. The signal line. There is a common misconception when it comes to the lines of the MACD, that the two lines that are drawn are not moving averages of the price. The MACD line is the difference, or distance, between two moving averages. These two moving averages are usually exponential moving averages, EMAs. When looking at the indicator, the MACD line is considered the faster moving average. The difference between the two MAs is plotted as one line, and a second line plots a smoothed version of the first line. These two lines appear on a chart as a technical indicator and oscillate without boundaries. The crossover of the two lines gives trading signals similar to a moving average crossover system. When the MACD crosses above the signal line, an uptrend may be emerging. Conversely, when it falls below the signal line, a downtrend may be emerging. On our chart, the MACD line is the difference between the 13 and 21 period moving averages. The signal line is the moving average of the MACD line. When looking at the indicator, the signal line is considered the slower moving average. The slower moving average plots the average of the previous MACD line. Once again, from our example above, this would be a 8-period moving average. Most charts use a 9-period exponential moving average, EMA, by default. This means that we are taking the average of the last 9 periods of the faster MACD line and plotting it as our slower moving average. The purpose of the signal line is to smooth out the sensitivity of the MACD line. Histogram. The histogram simply plots the difference between the MACD line and signal line. It is a graphical representation of the distance between the two lines. It may sometimes give you an early sign that a crossover is about to happen. If you look at the chart, you can see that, as the two moving averages MACD line and signal line separate, the histogram gets bigger. This is called a MACD divergence because the faster moving average MACD line is diverging or moving away from the slower moving average signal line. As the moving averages get closer to each other, the histogram gets smaller. This is called convergence because the faster moving average MACD line is converging or getting closer to the slower moving average signal line. And that is what MACD stands for, moving average convergence divergence. So, now that you know what an MACD is, let's now show you how to trade with an MACD. Here are 4 common MACD trading strategies. How to trade with MACD. There are 2 moving averages with different speeds. The faster one will obviously be quicker to react to price movement than the slower one. When a new trend occurs, the faster line MACD line will react first and eventually cross the slower line, signal line. When this crossover occurs, and the fast line starts to diverge or move away from the slower line, it often indicates that a new trend has formed. From the chart above, you can see that the fast line crossed under the slow line and correctly identified a new downtrend. Notice that when the lines crossed, the histogram temporarily disappears. This is because the difference between the lines at the time of the cross is 0. When the MACD crosses above 0, this is considered bullish. When the MACD crosses below 0, this is considered bearish. As the downtrend begins and the fast line diverges away from the slow line, the histogram gets bigger, which is a good indication of a strong trend. 2. MACD signal line crossovers. Like with most crossover strategies, a buy signal comes when the faster line crosses above the slower line, and vice versa for a sell signal. Here, the MACD is the faster line, while the signal line is the slower line. When the MACD line crosses from below to above the signal line, the indicator is considered bullish. The further below the 0 line, the stronger the signal. When the MACD line crosses from above to below the signal line, the indicator is considered bearish. The further above the 0 line, the stronger the signal. 3. Histogram reversals. The histogram represents the difference between the MACD and signal line. This means that as the bars on the histogram move further away from 0, the two lines are moving further apart. When the price's momentum is strong, the histogram will increase in height. When the histogram shrinks, it is a sign that the momentum, whether bullish or bearish, is weakening. Once the initial momentum surge is over, a mound or hump shape will emerge. This is a signal that the moving averages are tightening again, which can be an early sign that a crossover is about to happen. This is a predictive approach, instead of the reactive approach that the crossover strategies take. The histogram reversal is based on using the existing trend as the basis for entering a position, which means the strategy can be executed before the price movement actually occurs. 4. MACD divergence. The divergence between the MACD and price is a strong signal. When price makes a lower low, or higher high, MACD should also make a lower low, or higher high. Both should move in the same direction. But when it doesn't, there is divergence. On the chart, the price made a lower low but MACD made a higher low. This divergence between price and MACD signals a possible trend change. In this case, MACD is hinting that the downtrend might be done. Think of the MACD divergence as an early warning sign for trend reversals, or at least, choppy market conditions ahead. There is one drawback to MACD. Naturally, moving averages tend to lag behind price. After all, it's just an average of historical price. Now let's review what we have learnt in this lesson. The MACD indicator consists of 3 components. 1. The MACD line, which represents the difference between 2 moving averages. 2. The signal line, which is a moving average of the MACD line. 3. The histogram, which is a graphical representation of the distance between the MACD line and signal line. I hope you now can understand what MACD is and how you can use it in your trading. MACD is still one of the most popular indicators used by many traders all over the world. I hope you enjoyed this lesson. We look forward to meeting you in the next lesson, and quickly, if you have not yet subscribed, help us out, Just hit the subscribe button now. We really appreciate your support. If you have any questions, please leave them in the comments section. We do read all your comments. And just a final reminder, if you have not yet checked out our website, head over there now and you will find one of the most profitable trading systems used by over 90,000 traders. Check it out now on smartforextrading.com. Thank you, and I look forward to seeing in the next lesson. Help the channel to grow. Like, subscribe and turn on bell notifications. We hope you enjoyed the lesson, and we will see you on the next one.